What's up, guys? It's Cody here. Today we're talking about how you can get better terms on your loans. I've been getting a lot of questions about this on how you can get better terms and how you can get a lower interest rate and lower fees on those mortgages. And when it comes to investing in real estate, there's typically two restrictions that people complain about most, and that is number one, having the capital to use for a down payment, and also number two, being able to get qualified for a loan with terms that are favorable for you. Now, of course, before we jump into this, I know some of you are going to say, well, it is possible to buy a home without a traditional loan or without a huge down payment amount. And we're going to discuss those in future videos, but for the sake of this video here, we're actually going to bypass those discussions. My goal for this video is to keep it based around the traditional methods of getting real estate financing so that you can go out and you can find a bank or a credit union that's willing to give you more favorable terms. This is going to help you buy your first or next rental property. So let's jump into it. Before we start talking about how to get better loan terms, you need to understand that there are different types of loans. Now, I'm going to get a little bit basic here. We're going to talk about which loans are best and which one will be the best option for you, and which ones you can use to make sure that you got the best deal on your rental. So the first type of mortgage that we're going to be talking about here is your traditional methods of getting a mortgage. This is going to include your conventional mortgages and your FHA mortgages. Now, these two categories do make up about 90 to 95% of all loans that are out there, and they're going to be the most common. The second type of loan category that we're going to talk about is portfolio loan products. Now, these are very similar to that first category, but they do have some very small differences that will potentially make it more beneficial for you to look into one of these loan products versus just going with a traditional loan. These portfolio products typically come from local banks and local credit unions. Now, there are a couple other ways that you can get financing on property. Of course, you've always got private money and hard money, and the fourth option is going to be seller financing. For the purpose of this video, we're going to be talking about the very first two options. Before we talk about number two, which is the loan product that you're actually going to want to go with, we're going to need to talk about how traditional loans work and what those typically look like so that you know what kind of deal you're getting on a portfolio product and if it's the right fit for you. So first off, let's talk about conventional loans. Conventional loans are going to be loans that are given by just about any bank out there that agrees to give you a loan based on your credit and financial profile. These are typically bought and backed by companies like Fannie Mae and Freddie Mac. This is the more traditional way of getting a loan, and it's kind of what's been used in the past. However, the one that is becoming more common is the FHA loan. Now, FHA is actually a subsidiary of HUD. So FHA stands for Federal Housing Administration, and they are a subsidy of HUD, which is the Division of Housing and Urban Development. What FHA does is they actually insure the loan so that if you as the borrower are going to default, they're going to reimburse the bank that holds your note. They do this so that they can offer you better terms. This is why the interest rates are typically a little bit lower, and they can get you in with less of a down payment. It is, however, important here to note that Fannie Mae and Freddie Mac may purchase an FHA insured loan, and the FHA is not usually the one who holds your loan. They simply insure it. Now, I don't want to go down the rabbit hole of too many details here because it can get very complex very quickly, but it is important to understand kind of how those two different methods work when it comes to traditional financing. All right, so now that you understand how traditional methods of financing work with conventional loans and FHA loans, you can finally smash that like button if you haven't already done so already. No, just kidding, guys. We're going to jump right into this. We're going to be talking about portfolio loan products. This is what you've really been wanting to hear about, and this is what you're going to want to look for in your market to see how you can get better terms than what is offered on a conventional loan or even FHA. So before I jump into that, I do want to say that typically if you're going with an owner-occupied house and you're trying to buy something that you're going to live in, whether it's just going to be a home for your family or it's something that you want to house hack, going with a conventional loan or an FHA loan is very often the best option. You can get in for a very low down payment, and the rates and the fees that you're going to pay on mortgage insurance are really not that bad. However, if you're strictly looking for something that's an investment property and you want to get past the requirement of having 20% down and 12 months of reserves, this is going to be something that you want to listen to. So what are portfolio loans? Well, these are actually going to be loans that banks keep in-house. So you've got local credit unions and local banks in your area that people are going and depositing their paycheck into every single week. And the bank takes that money and then they loan it out to other individuals based on their credit profile for things like car loans and mortgages. This is called a portfolio loan product because they are keeping it in-house in their own portfolio. Many times when you go and get those other traditional methods of financing, you might have a broker who originates the loan and agrees to set everything up for you, but then your loan may be sold multiple times over the coming years. Now, the cool thing about these portfolio products is they vary from traditional financing in the sense that with traditional financing, because that loan may be sold many times and it's going to be insured by government-backed entities, it's important for those traditional loans to have very strict guidelines that meet a very wide consensus of what is approved and what is not. With portfolio products, you've got more flexibility. The bank is agreeing to lend you their own money that people have deposited with them, and so they're able to give you more flexible terms. Now, what I mean by that is the flexible terms may vary from bank to bank, right? They typically have higher requirements on income, assets, reserves, credit score, things like that, but they're willing to give you a better interest rate and a lower down payment amount. For instance, in my market, there's actually a credit union that's here locally that has a 10% down loan product and a 15% down loan product on investment properties. The cool thing is here, they will also let you do a cash out refinance up to 90% of the value of the home. This is great because most banks will only let you go up to 75%, maybe 80% if you're lucky. You do have to be a little bit careful because not every home makes sense to pull out that much money, but in some situations you can get a house that still produces cash flow and has enough to cover the mortgage each and every month that you can actually use that cash out refinance to get your money back. I actually recently did one like this using a local credit union's portfolio loan product. If you haven't seen that video yet, I'm gonna link to it right up here. It's one of my best videos. You're really gonna love the information inside of there, so go check it out. So jumping back to what these credit unions and banks are gonna require, they typically follow guidelines that FHA or Fannie Mae and Freddie Mac have put into place. And the reason why they do that is because it's a very good gauge of the confidence that they're gonna get paid back the money that they loan to you. But because the bank is going to be holding the loan and they're not looking to sell it off to somebody else, they can give you more favorable terms. Like I mentioned, they're typically a little bit more picky on things like credit score and assets as well as reserves, but they're more flexible on other things like down payment and no mortgage insurance. These are great methods of getting loans because it really gives you the flexibility, especially if you've got a decent income, you've got maybe a home or two already, and you've got some money in the bank set aside for reserves, as well as a high credit score. This can be a really good way to get into another property without having a 20 to 25% down payment. So now that you know what portfolio loan products are, it's now time to talk about how to find them. Well, let's not overcomplicate it, guys. Like I've already mentioned a few times, these are local credit unions and local banks in your area that are wanting to issue these loans to you as long as you meet the requirements. The first thing that I would do is I would write down a list of 5 local smaller credit unions and banks in your area and either walk into the branch and ask them if they have anything like this or give them a call. The second thing that I would do to actually find loan products like this is ask around. There's many online forums. You can use Bigger Pockets, you can use Facebook, or you can also use local resources with other investors who may know about these opportunities. You want to make sure that you're asking around to other landlords, other realtors, even just other people in your local area to see if they know about any banks who have specific loan products like this. It's always a good idea to have an idea of what kind of loans are out there so that if something comes up, you can always go in and you can get the process started right away. If you've got a great deal that you need to take advantage of, you can do that right away. And I alluded to this a little bit earlier, but try to stay away from mortgage brokers. Typically, these guys are acting as middlemen between you and the bank, and they will charge you a higher interest rate or higher fees, which is how they get paid. They're called mortgage brokers for a reason, guys, because they're brokering your loan. One last thing before we wrap up this video, it's always a great idea to get pre-approved for a loan, whether you're planning on buying something in the next month or it's gonna be 6 months or 12 months down the road. it doesn't matter. It's always a good idea to have a pre-approval in hand so that you can act quickly if the next property comes up and it's a great deal. Being a real estate agent myself, I always find that the best deals in the best area that are priced right, they always go quick, and you need to be able to jump on them very quickly. So that wraps up the video, guys. I hope this was helpful for you. I hope you learned a little bit about how to use portfolio products and how to go out there and find them so that you can get better loan terms on your deal. If you liked this video, please give me a thumbs up down below. Subscribe to the channel if you haven't already done so. Click the bell if you want to get notified when I release new videos like this. And as always, drop a comment if you have any questions or if you've done something like this. I'd be happy to answer them, give you some guidance, and until next time.